price retraces back to the demand zone, we have an opportunity to go long in this market with a stop below the low in between the two highs and a target that is 3 to 4 times as large as the stop as we discussed earlier. So let's fast forward price to observe the changes in price action. In this very candle, we can see evidence of our demand zone working properly. Notice that as soon as price touches the demand zone, it immediately reacts to it by creating a large lower tail or lower shadow in the respective candlestick. That is a sign of buying pressure, which makes sense in prices entering a demand zone. By the way, if you want to learn more about candlestick patterns and their interpretation, don't forget to check my free candlestick patterns course in the YouTube card. As soon as you see the evidence that buyers are still hanging around the level of the demand zone, you can think about an entry. There are hundreds of different ways to enter in the market, so we cannot explore them all in this video alone. But here's one advantage of using supply and demand zones. Since we are pretty close to the logical stop loss level, you can enter the trade in the very next candle. That's not always the case, but in the situation that we are analyzing right now, it seems okay. Don't forget that the more precise you get in your entries, the less risk you're going to take, and the higher your risk reward will be, which means you will increase your margin of error dramatically. That will propel you forwards into long-term sustainability. By fasting forward price, we can see that the market would meander a little bit, and then it would start to go up using the demand zone as a cushion, and after that, hitting the appropriate target. The next example we are going to study is from a supply zone. This might be a little trickier because it will involve other highs and lows in the middle, but if you adhere to the rules I already established, it should be easy to filter out the noise and concentrate on the details that really matter. The first thing to notice here is that we have two lows highlighted. The second low is lower than the first one, so a supply zone will come out of the high in the middle of these lows. Now we need to move on to the upper and lower limits of the supply zone. In the case of a supply zone, the upper boundary is easier to draw because we can simply count on the highest point of the high in the middle of the two lows we highlighted before. The difficult part about a supply zone is determining its lower limit or lower boundary. That's because we need to find a place after the high where sellers really decided to bring the market down. Needless to say, this will vary a lot depending on the market scenario you are analyzing. That's why it's difficult to come up with one single rule that works every single time for all cases. This example is actually similar to the previous example where we examined a demand zone. Right after the high, we can see that there is an explosion of volatility to the downside. This is where sellers really decided to bring the market down, so we can use this as the lower boundary of our supply zone. There are other more advanced techniques that will point to different levels that can be used here, but I'm not going to go into detail about those since this is a beginner's guide. I'm just showing you the basics in here. The supply zone represents a range of price where strong sellers are likely to be at. If price returns to this level, there might be grounds for a short trade depending on what price does if it reaches the zone. Let's advance price to see what happens. At this point, we can identify a few different things in here. In the micro level, we can see that candlesticks pierce the lower boundary of our supply zone, and judging by the pronounced upper tail in this candlestick, we can see that there is some selling pressure in the zone still. So far, this is great evidence for a short trade in here since the current price action agrees with the supply zone. In a broader sense, however, the situation might not be so clear. Observe that by the time price retraces to the supply zone, buyers just got a new demand zone proven, and that is of course evidence for bullish strength. I want to point this out to you because there will be many times where you will find yourself in a situation like this, and then you will have to make a judgment call based on which market player is stronger and which one has more room to travel at the moment. This is also a more advanced subject, but I thought it would be a good idea to point it out to you. Despite all of that, we are at a supply zone with a very good stop loss level above the highest high in the chart, and plenty of room for price to travel enough to yield at least a 1 to 3 risk-reward ratio. If price goes back down there, the target will be more or less where the newly created demand zone is. So let's advance price to observe what happens. You can clearly see here that sellers indeed show up again and supported the short trade. These two examples highlight how supply and demand zones work in optimal scenarios. However, in real life, things are not so pretty. Because of that, I decided to show you a couple of more examples of what happens when supply and demand zones fail. Perhaps more importantly than knowing what to do when this technique works, is knowing what to do when it doesn't work. It's not difficult to find examples of failed supply and demand zones. We don't even have to change the chart for that. Let's use the example of the demand zone we identified in the previous example. We have the low in between two highs where the second high is higher than the first one, so at least in theory, we are dealing with a strong demand zone. To draw the lower boundary of the demand zone, we can simply go to the lowest point of the low in between the two highs. And once again, the upper boundary can be determined by the shift in volatility that happens right after the low. Let me remind you once again that this is not always the case. There are many more examples of market scenarios where it's really difficult to pinpoint one of the boundaries of the zone. We can already see that this demand zone clearly failed, but there are clues you can spot to help you identify that in real time. The most important thing you can do is to watch what price does as it reaches the zone. Notice that in this case, price simply ignored the existence of the demand zone. As price touches the upper and lower boundaries of the zone, there is no evidence of bullish pressure of any kind. On the contrary, there is only evidence of bearish pressure. It is as if the demand zone wasn't even there in the first place. However, even if you ignore this fact and you took a long trade there, the stop loss would still be pretty small and the damage would not be so big. This is once again one of the great things about the supply and demand zone technique. It gives you a logical and small stop loss order placement. Notice that if you took the previous short trade in the example about the supply zone, you also